an absolute minimum, and the result of the risk-based capital approach, quite similar to, I think, to what we are seeing in the Ghana expectation. However, a key difference from a Kenyan perspective was the standard formula. There's a standard formula that results in that risk-based capital calculation, as opposed to Solvency II and SAM. The result of the standard formula informed the minimum capital requirements, not the solvency capital requirements, which sort of includes that buffer, and that was one of the key things that we saw. Incidentally, of course, it then meant, even as that was being implemented, the buffer, which is now the prescribed capital over and above the MCR, was set at twice that MCR. So it then meant that many of the insurers in Kenya already had an uphill task when it came to implementation of risk-based capital. As part of the transition, there was a 3-year transition period between 2017 and 2020. Of course, COVID happened in 2020, and there was a pause of that for around 2 years between 2020 and 2022. But even as we speak now, from a capital requirements perspective, roughly a quarter of the insurers in Kenya, based on the results that were published last year, 2024 under IFRS 17, a quarter of them was still below that minimum capital requirements, yeah? Another, roughly around the same number also were above the prescribed capital requirements from Kenya, which also speaks to even the, the challenges that insurers have been having in terms of even adapting to the new standard. But it has not been fully enforced by the regulator in Kenya, but that sort of speaks to, what the insurers in Kenya have actually been facing from an required capital perspective. I won't spend a lot of time also on the available capital. The structure in Kenya is largely comparable to the proposed structure for the Nigerian risk-based capital requirements. Broadly, of course, we have the tier 1, tier 2 with a deduction on inadmissible assets. Since the implementation of IFRS 17 in Kenya, of course, insurers are now given the option of using subsidiary capital, tier 2 capital, to shore up their capital requirements. We haven't seen a lot of that happening in Kenya. A few insurers got subordinated loans to sort of shore up their capital in the short term. Of course, that one required regulatory approval. So the expectation, of course, even from that side is the minimum capital requirements should be covered fully by tier 1 capital. A big issue that we had from a Kenyan perspective was how the inadmissible assets were treated. And of course, noting quite a number of insurers invest quite a bit in intangible assets, particularly with digital transformation and the like. We saw that coming through in a big way to reduce the available capital. From an IFRS 17 perspective, and this is a conversation that is currently ongoing, with CSM, being introduced under IFRS 17 as a concept, with the concept of the unearned profits, there are discussions going on around how that should be treated as part of available capital, yeah? One of the key things that insurers had to adapt with the move to risk-based capital, particularly when determining the available capital, was essentially that dual reporting concept that had to be affirmed with RBC, with the expectation that the balance sheet is a consistent balance sheet. So any assets, largely any assets that were not measured on a market value concept had to be converted to market value, yeah? And that's also something that many insurers had to also grapple with. I'll cover the two last items later in my presentation. So from a transition perspective, as I mentioned, in Kenya, we had a 3-year transition period between 2017 and 2020. But even then, there was already a lot of engagement that happened before the regulations were formally implemented in 2017. We're coming from a point of view of the industry where we're already adopting actual best practice, from 2013 when the industry was required to have, actuarial resources within the companies, and having external actuaries and the like. So there was quite a bit of challenge with regards to data for calibration of the risk charges. So in fact, for quite a number of the risk charges, a number of those risk charges were actually borrowed initially. And it's a then meant that even those risk charges that were already in place were not actually properly calibrated, from the onset. And it's one of the conversations that we've been having with the regulator. The value at risk measure, the confidence interval that was being used, wasn't very clear from the beginning. And it was one that was subject to a lot of conversation with the industry, even post the implementation of the regulations. And it became particularly important when it came to IFRS 17 implementation. Of course, as you may be aware, with IFRS 17, there was now a requirement to have an explicit risk adjustment. And to a large extent, many insurers leaned on what they already had under the risk-based capital approach to determine that risk adjustment for purposes of IFRS 17 reporting. And that is also something that also came out during that process. There was quite a bit of qualitative impact studies. We had 2 quantitative impact studies before the implementation itself. And it was useful for purposes of the engagement with the industry. In fact, one of the quantitative impact studies was done by the Association of Kenya Insurers to sort of, get that sort of independent feedback on the same. And it was very useful in terms of informing the conversations with the regulator. Based on the quantitative impact studies, we actually saw a big decline in the capital adequacy ratios compared to the old approach. As you can see there, for general insurers, a drop from an average of 220 to 131%. For life insurers, it was more than half, So there was quite a bit that came out even out of the first QISs that happened around the same time. And actually that then informed, a couple of the changes that had to be made to the risk-based capital formula to ensure that it's also worked well for the market. Of course, from the Actuarial Society of Kenya, we also had a working party that was put in place to sort of address this. This working party was crucial in terms of articulating the voice of the actuarial profession. It worked closely with the industry body, the Association of Kenyan Insurers, in terms of understanding the risk-based capital requirements. It led some of the QIS studies within the insurance companies for the members that are part of the Actuarial Society of Kenya. There were particular capital charges that the association also took charge in terms of trying to understand the capital charges that were put in place. And in particular, we have the market stresses that was of particular importance to the industry. Even with the regulator giving feedback into the risk-based capital framework and making changes, it didn't quite fit the expectations of the profession. And the task, the Actuarial Society of Kenya further went ahead to develop some additional technical guidance to the practitioners as they were implementing it within the insurance companies. Then, of course, as actuaries and having a good understanding of the risk-based capital, the expectations and the reasoning for it, the members played a key part in terms of socialization of RBC within the insurance companies, the boards, with management and their colleagues within the companies. I'll cover briefly the key matters that came out of the RBC. One was the allowance for the loss absorbing capacity of deferred tax liabilities. So what happens in Kenya, particularly on the long-term side, is there's a restriction in terms of the amount of surplus, actual surplus that you can attribute to your shareholders at the end of every year. You can only attribute up to 30% of your accumulated surplus to the shareholders, and that's when it moves from your statutory reserves to your retained earnings. And typically, of course, the amount that sits within the surplus is not taxable. So there's a deferred tax component for the unappropriated surplus, And a key part within the RBC is it did not allow for that loss absorbing capacity of those deferred taxes, In case of any stresses, to the industry or any shocks to the company, typically the deferred tax liability would reduce to absorb, the those losses, yeah, because essentially your accumulated surplus will reduce, yeah. That was not actually taken into account. It took quite a bit of engagement with the regulator to allow for that. I've covered the second one, which was the standard formula being a result for the MCR as opposed to the solvency capital requirement, which is standard elsewhere. And it's one of the items that really came out. Initially, when capital charges were introduced for the assets, for all insurance companies, capital charges were actually also applied to assets that back investment-linked liabilities, yeah? Where the insurance companies do not necessarily take on or have any risk with regards to those assets, but that was eventually resolved. Another big one, of course, which was also a big introduction, was the interest rate risk charge, which was set at an initial very high level of 20%. There was quite a bit of engagement with the industry that led to that being reduced to 10%. And we have one, of course, that spoke, the last points there, that is also an improvement area from a risk-based perspective, that then required, that wasn't allowed for with regards to allowing for sort of correlations or diversification benefits within particular risk modules. So I'll just cover brief in terms of the implications from the industry before I look at sort of what next, and or rather, despite this, what you can learn from our experience. Of course, there was initial pushback from the industry. Capital requirements, having to increase capital wasn't pleasing to many insurance companies at that point. There was also, it's led to quite a bit of product review, product rationalization. The good thing about risk-based capital is also put into focus, you know, it gave a better view of the performance of your products based on the capital that is required for the products that you have. And in particular, we saw a business, the annuity business in Kenya. I know it's also a similar item here in Nigeria as well, where there's quite a bit of rationalization with regards to the annuity business in Kenya. There was quite a bit of balance sheet restructuring, particularly on the asset side, to ensure that there's a better match between the assets and the liabilities, because the risk-based capital charges, you know, placed a lot more onerous requirements on properties, you know, equities and corporate bonds. So we saw a lot of insurers, particularly on the short-term space, also divest from these assets. Of course, there's a lot more focus on the quality of the business and the profitability of that business, linked to sort of one of the points there. Over time, we then saw remuneration policies actually change. And as you see from my later slides, it then meant that there was a much closer link between, you know, the return on capital and, you know, what leaders, you know, management teams were getting as remuneration. A big issue from a Kenyan aspect was on credit risk. Credit risk is actually, even till today, still remains one of the key contributors of, you know, the capital charges within the risk-based capital framework. We saw an improved credit risk management, you know, for insurers that were already within that space. And then, of course, overall, there was an improvement with regards to the risk culture. And within the next, as I wrap up in the next few slides, I'll cover even my own personal example, because back then, I also used to work for an insurer, and we then, you know, took this risk-based capital approach a step forward from the perspective of economic capital management. So I'll cover a bit around the economic capital approach, because then with risk-based capital, insurers then have an opportunity to have in place within the organizations an economic capital, you know, framework because you need to look at when you're maintaining capital, you're not just maintaining it for the regulator. The capital that you're holding needs to meet the requirements of your business, yeah, in terms of your growth. And also typically, there are also wider stakeholders that also need to be catered for, particularly from a capital perspective. Insurers also rely a lot on credit rating agencies for reference, you know, to affirm the strength of those insurance companies. And the economic capital approach will then lend a lot of credence in terms of, you know, even getting a better rating, in terms of demonstrating that you're maintaining your capital resources very well. So adopting the risk-based capital gave a very good starting point, particularly for insurers that were still early in their journey. Of course, we're in Africa and we've spoken about the skills that are available within the continent. We're in a low resource setting, yeah? We're still building our actuarial skills, but even then, we can still then use the risk-based capital approach to then have in place some of these economic capital requirements. Tied to pillar 2 of the risk-based capital, the pillar 2 of the risk-based capital requirements, OSA is one that many regulators are starting to put in place. And the risk-based, having some sort of economic capital within the company allows you to then demonstrate that for purposes of your own risk and solvency requirements. And this risk-based capital formula can then be a good place where you can even now start adapting it to using it for your economic capital requirements. I won't spend a lot of time talking about the need for an economic capital framework. I've covered quite a bit of this. Of course, automatically your compliance with your regulators will essentially be covered. I've talked about the stakeholder confidence there. I'll spend a bit of time in my next 2 slides as I close on how we can then make a better link between your capital requirements and your risk management framework, or your risk posture within the insurance company. So, as I mentioned earlier, with risk-based capital, we sit in a much better place to link our capital requirements and the risks that we take on, yeah? And with that, and given also the increasing reporting requirements with regards to your own risk and solvency, it offers a very good opportunity to then integrate your enterprise risk management framework and your capital management framework, yeah? And this becomes also particularly important in the current era that we live in. Of course, now we report under IFRS 17. With IFRS 17, we're required to maintain also risk margins. This risk margin must be based on your own view of your risk appetite, within the company. And it then makes a lot of sense to ensure that, the risks that you hold are tied in some way to the capital that you then expect to hold, which fits in very well with the risk-based capital framework. And with that pillar 1 approach that is being introduced under risk-based capital, the various risks, it then allows you an opportunity to then, consider and bring in those external risks, that you're faced with as a business, based on even also your risk appetite and how you define your risk appetite. You can then, through that process, come up with that economic capital level that you aspire to have, and you can then integrate that into your strategy. From a forward-looking perspective, of course, to a large extent, the risk-based capital model as it currently set is based on your risks now. You can then incorporate that forward-looking perspective, which also links very well with your own risk and solvency assessment also, by having those multi-year projections, based on your strategy. When you come up with your business plans, you embed what you expect as your capital requirements going forward, what is your capital adequacy ratio, how that will come in going forward, and also allow you to effectively allocate your capital across the various products that you offer, yeah? That can be at portfolio level or at product class level, to then allow you to have a full view as to where does my capital go, which products do my capital support, what are the returns on capital, what returns on capital am I getting for those products, and what do I need to do to rationalize my products. Tied to that, of course, and this is also something from my experience that we're able to do, we then put in a formal governance process to inform this. That then meant that all this was actually tracked and monitored and actually fed back to strategy and to risk. I'd like to close with this slide from that governance perspective. And already by integrating that capital management framework based on the learnings from RBC within your existing governance structures within the organization, you can then be in a position to actually use it to add value to your business, yeah? We already have, from a governance perspective, you know, your board of directors with your board risk committees. You also have your audit risk committees. And then on a day-to-day basis, of course, you have your management committees, yeah? By embedding this into your risk management framework and through your board risk committee, through your ERM framework, by clearly defining your risk appetite, yeah, and then integrating it into your capital management framework, you're now in a position to have a view around the capital that you're expected to maintain, and that then will be a good place to track, you know, your overall capital levels with the support of, you know, the management risk committee. So on a day-to-day basis, once you have that risk management framework that is clearly defined, you know, your risk capital clearly defined, even as you implement your strategy, as you determine the capital requirements, even from a forward-looking basis, you then take into account, you know, management actions, yeah, in such a way that you have a view as to, you know, what will be my capital levels based on the risks that I'm exposed to and the management actions that I come in with. From a management function perspective, the risk team, the risk management team, together with the actuarial team, will then be largely responsible for the implementation of this capital management framework, where, of course, as actuaries, we then come in to implement and to use that particular capital model. Then also from a governance perspective, and to ensure that that capital framework continues to be, you know, the use case continues to be relevant. Of course, there need to be some governance process from an audit and risk, from a board audit perspective in terms of, you know, having a regular review of the same, and that's even now where your sort of external actuary may also come in to provide an independent audit review and validation of that economic capital model. This is a model that has worked. I'm also aware, even from a Nigerian perspective, and even before the risk-based capital model was implemented, we already have, you know, insurers who already put in place some sort of economic capital framework that they use to then track their performance from a risk-based perspective, and particularly with the introduction of risk-based capital, those particular insurers will be at a much better place, you know, to make the transition from a rule-based approach to a risk-based approach with the same. So I'll just stop there and welcome any questions based on the experience and also what it can do for you from a economic capital perspective. Thank you very much.
Thank